Welcome back for installment 3. I'm Rob Kaplan, founder and partner at Kaplan, Vogler, Cunningham & Frank. I'm joined by Ray Davis, Chief Business Development Officer at Red Oak Capital Group. Now we're going to get into the meat and potatoes of the initial offering that we did. Let's start with a little bit about, don't have to go into a lot of detail, but that initial offering structure, how it was arrived at, and what kind of market investigation did you do, and what conclusions did you arrive at from that really helped inform us as we created that structure?
What's interesting for the audience to know is our initial Reg A offering is actually a bond offering, but it started out as an equity offering.
Mm-hmm.
We went to the market and when we were testing and doing that feedback loop we discussed, and the market said, look, we want definition of exit date. We want to know date certain when we're going to get our money back. And so what was very unique about that hadn't been done in the market is we said, well, sure, we're happy to do that. With a bond offering, we had to significantly increase our reserves. I believe we had a sinking fund in our first fund offering. We have reserves at the asset level. We have additional reserves at the asset level. We're backing it by our equity, et cetera. But I think the neat thing there, Rob, is for the audience, we wanted the investors to have some upside with our initial bond offering. And so it was never done what we were trying to do. So we took the initial offering, we turned it into a bond offering, a 5.5 year, I believe. And what we did is, with Rob's group's help, we came up with a contingent interest payment.
Right.
So although we have a bond offering, which typically pays X in the way of interest on a quarterly basis in our case, with the contingent interest structure that the group developed, and our CFO is a big part of this, Jason Anderson, in conjunction with Rob's law firm, we developed this contingent interest payment. So when we're talking about structure and solving for problems and being creative, this is just one of the things we've done. And I think those type of things really set us apart with our deal structuring. That's one of many, Rob, but I thought it was worth noting.
Yeah, I think another thing we should bring up real quick, which is important for people to think about, and when you're going to the independent broker-dealer space in the RIA community, is in most of these alternatives, remember, Reg A right now doesn't have a very vibrant trading market for those securities. Liquidity is an issue for investors and their advisors. One of the things we've done for Red Oak and others is to establish redemption features that can be used to provide a level of liquidity. I think a lot of investors, they look at a 5, 6, 7 year investment and they love the business model, they love the returns, but there is that unknown of, well, what happens if my wife gets sick? Or what happens if one of my children, heaven forbid, dies and I have to take care of their kids? And so providing those redemption functions or early payment functions in order to provide a modicum of liquidity, and they can have discounts associated with them or what have you, has been something that has really helped the marketplace accept new products. And I think it is becoming a bit of a standard out there in the IBD community to have these features.
You're spot on, Rob. All of our new offerings have liquidity from day one. Mind you, it's a 90-day notice with a 90-day redemption. But again, that's really solving a problem. Going back to our distribution partners, it's solving a problem with the regulators where they prefer higher liquidity within the offering. Primary issue we get with structuring regulation, in our case Regulation A offerings or any offering, is the load associated with the broker-dealer channel. We get this question all the time, how are you structuring around the load? And so we address this a couple different ways. Sure, there's a load associated with the broker-dealer channel where the rep gets a commission and there's other folks that are being paid, and those are amortized over a period of time. But when we talk about load and structuring, our thought and our philosophy has always been, once you have your core product in the market, since then, with Rob's help, we've structured every fund to either mitigate risk and or offset that load. The typical two schools of thought are, I'm either going to go with the independent broker-dealer channel, which there's a load associated with it, or I'm going to go institutional. And we, Red Oak, with Rob's help, and of course all my partners at Red Oak, we took the approach of we've got a core product in our Regulation A offerings, and we've made complementing offerings, and we've blended institutional capital to offset that load. And just trying to keep it real simple for the audiences, what we're talking about here is dollars in the ground. With institutional capital, it's almost 100 cents going in the ground. With the broker-dealer channel and RIA channel, it's something less. But through our subsequent offerings and having a global capital strategy, we've been able to drive significantly more dollars in the ground than most of our competition.
Right.
Not all of them, but most of them. But again, that comes back to the firm structuring, you guys getting creative with us. And I thought touching on that, you may want to elaborate on that or just add a little bit of color to it if you have any, but it's an important feature.
To be clear for the audience, most people probably know this, but there's probably a few that don't. When we refer to load, we're referring to, one, fees and commissions payable to distribution professionals associated with raising the capital. It can also go, and I do think this is an important thing for people to recognize in the planning process and in developing the long-term building plan, is that there is an element of your G&A costs that, while not legally for disclosure purposes associated necessarily with load, is a function of the load. And in the next installment, we'll be talking a lot about the marketing effort that was associated with the distribution of the first offering. But a lot of those expenses factor into that load. With institutional capital, you don't have a lot of that because, they're putting big slugs of money in, taking very significant positions in the company, and therefore they want maximum dollars going into the ground. In the retail space, you're dealing with third-party professionals who sell your products, and so they are motivated by commission as much as they're motivated by doing right by their investors if they're in the brokerage model. And so there is an expense associated with that. You get a passive investor, but you do have a load you need to work with. So, what we have done is worked with Red Oak and other issuers to try to lessen the front end impact of that load feature, whether that would be creating load structures which pay a part of the commission up front and then pay an annuity over time, or providing for renewal features for investments that provide an additional load to the brokerage professionals so that we can negotiate a lower load on the front end. I don't mean to make it sound like we can take your load and reduce it by 50-60% on the front end, but we can work with you, and if you have the right relationships with the brokerage community, we can work with you to create structures which can get that load feature down noticeably, and that then equates to, as Ray said, more money going into working capital for operations, or in Red Oak's case, lending to real estate groups out there that produces the income, or if it is a developer, for the development projects.
To just close out that point, they both have their advantages. Institutional capital, you get significantly more dollars in the ground. The independent broker-dealer channel, you have capital that's typically committed to you for a longer period of time. And our position has always been the independent broker-dealer channel is invaluable to us. You have committed capital, and with us, we take that base and we blend it with institutional capital. Now, as number 16, I've had plenty of situations where institutional capital, at the change of a market, have pulled out all capital. Now a company and 20, 30, 40 employees is sitting dead in the water if they have no capital base. So I like the independent broker-dealer channel for that reason. And you're providing a solution that Mrs. Jones, per se, can't get, by trying to go and do it on her own. She's now got a financial professional helping her make investment decisions that fit her specifically.
Yes, I agree. If you have questions, contact information is below on the site. And of course, please feel free to reach out to myself or Ray or Nick on the blog, and we'll get back to you as quickly as possible.